Welcome to the AFA 2009, the AFA lecture. I'm David Hirschleifer, chair of the AFA program this year. The AFA lectures were started in 2011 as a way of bringing speakers who don't live in a finance department as their primary home, but have insights that finance scholars should know about because of their relevance for deep and topical issues. Our speaker today, Matthew Jackson, is one of the leaders in the new science of social networks. And I hardly need to make the case that networks are important for finance, given the rise of the network economy, the development of new financial payment and investment systems with social media firms. But I'll add that in the general area of social networks, there's been an explosive growth in interdisciplinary research, creating an exciting new field. And again, Matt is a leader in this field. And furthermore, not everyone in this field takes an economic perspective and applies economic ideas such as incentives, optimization, and equilibrium to understanding social networks and understanding the economy. So we're very fortunate to have Matthew Jackson here to tell us, to help us on these issues. Matt received his PhD from Stanford in 1988 and has been the William E. Burrell Professor of Economics at Stanford since 2008. He's a highly celebrated economist. He's a fellow of the Game Theory Society and of the American Academy of Arts and Sciences and a member of the National Academy of Sciences. He's a recipient of an honorary doctorate, and that's just to name a few of his many honors. Matt is also frighteningly productive. On his CV, pages 6 through 15 are his papers, and that's not counting 2 more pages of working papers. In addition to his seminal research, Matt has devoted himself to helping others in important ways. He has taught and has co-authored with rising junior network scholars, and Matt has been involved with organizing conferences to advance the field. Furthermore, he has developed 2 MOOCs, massively online open courses on game theory and on networks, which he teaches to massive numbers of students around the world. He literally wrote the book on social and economic networks, a book I very highly recommend to you. And I'm waiting very impatiently for Matt's new book for a general audience, which will come out in March, entitled The Human Network. Matt's presentation today is on what makes financial networks special, understanding and evaluating systemic risk. The issue of systemic risk, of course, is crucial for finance and for the macroeconomy, as we all understand even better since the 2007 financial crisis. And it's intuitively clear that financial networks, in turn, are crucial for understanding systemic risk. So we're very fortunate to have Matt to talk to us about these issues. And so with that, I'll turn things over to Matt.
So first of all, thank you very much to David for the kind introduction and also for organizing this session and having me here. It's a pleasure to be able to talk to you about this. This is a project that is brand new with Agata Pernu, and we just posted a version of it to my website so you can download a paper. It's very preliminary, but what I'll do is take you through an understanding of what we can learn from network science in general and what's special in particular about financial networks, and then how we can address systemic risk in these areas. And I'll start by just saying some fairly obvious things, but then I'll take you through them and how they work. We're in an increasingly interlinked world economy and financial system, and along with that has actually come a series of great benefits, but it also makes the world very interconnected, and that produces some peril, and basically the peril is that there can be catastrophic events in one part of an economy that end up having ramifications not only countrywide but worldwide. And we've experienced that in the past decade and understand it more now than we did before. And the science is starting to catch up a little bit with the empirics, and I want to talk a little bit about what we learned from the science and where we should be thinking for the future. And in particular, along with the sort of growth in the globalization has come a growth in science, and in particular in understanding of networks. And it provides us with a basis for understanding systemic effects. And applying that in the area of systemic risks in finance involves understanding that those are special networks in a couple of ways. And the first way in which it's special is that the externalities and inefficiencies in these kinds of markets are quite pervasive and deep. And they're the key to understanding why we care about systemic risk and what in particular we should be paying attention to. And the other part is that when we look at financial networks, they don't look like a lot of other networks. There's certain shapes to them, there's certain patterns that they exhibit, core periphery structures, other kinds of structures that are special to this kind of context and that require additional understanding. And so we're going to look at these kinds of issues as we go along today. So and I'm just going to hop right into the outline because that I think will take us through. What I'm going to do is I'm going to start with some basic background on networks and globalization. And this is going to be big picture stuff far beyond just the financial part. And then I'll zoom into how financial networks have been evolving. And then I'll start with sort of a basic lesson in epidemiology and contagion. So what do we learn from spreads of diseases? And then how are networks in financial settings different from the contagion of a flu and so forth. So that'll be the second part. The third part will be the newer part in the paper with Agata, where we're basically then looking at incentives in these settings and trying to understand who partners with whom, what kinds of contracts they set up, and how that leads to an increase in potential systemic risk. And then at the end, I'll say some words about how we measure and address these kinds of risks in the given setting that we're looking at. Okay, so let's hop right in. And what I'm doing here is actually pulling a bit from the book that David just mentioned. So I have a new book called The Human Network, which is coming out. And I'm going to pull some just general trends of how networks are changing over time and what kinds of things are accompanying that change. So in terms of global trends, first thing, there's been a general increase in density of trade and alliances, both economic and political alliances. Along with that has come a dramatic increase in peace and decrease in poverty. And I'll sort of say a little bit about how those fit together. At the same time, we're also seeing some increases in polarization, and I'll mention that and give you some pictures of that and talk a little bit about what network science has to say about that. And we see some elements of that in financial networks, so it's not just a tangent, but it actually fits in. And then I'm going to talk in particular about the growth in the financial network and some consolidation in that network and basics about that structure. So this is going to be sort of the basic global trends part, and then we'll get into what does this all mean and how do we measure and deal with it. Okay, so the first thing I'm going to take you through is actually from a project with a former student, Stephen Nye, from a few years ago. And what I've pictured here is shortly after the Napoleonic Wars, we're looking at world alliances. And so if people can't see in the back, you might want to move up a little bit because these pictures here are going to be really important to the story. But here what we've got is we've got data on alliances. Each node here is a country, and there's a link between two countries if they had a formal alliance, either a defensive alliance, I'll come to your aid, or non-aggression, or neutrality alliance, some sort of alliance between two countries. And what's interesting about this is I'll just take you through a time series of these networks over time. So this is after the Napoleonic Wars. You see sort of a dense network within Europe. It moves a little bit by 1825. 1835, we're getting some more movement. 1845, 1855, 65. 1870, things started to fall apart. Alliances start disappearing. 1885, we see a few alliances. 95, 1900, 1910s, just before the First World War. 1920s, 30s, 40s. Okay, now we get to interesting period after the Second World War. Things start getting denser. 1960, 1970, 80, 90, 2000. There we are. Okay, so I haven't gone all the way up to the present, but basically what's happened, as you've seen, is this network was bouncing around quite a bit in the earlier periods. There were few alliances, they weren't very stable, and now you see a gradual densification, and it's just been filling in, and these alliances have become more stable. In terms of actual numbers, if you look pre-World War II, a typical country had 2.5 allies, and if you looked at any particular alliance, there was a 2/3 chance that it would still be there 5 years later. If you look post-World War II, countries have on average 10.5 alliances, and there's a 95% chance that it's still there 5 years later. So you've seen both a growth in the density of these alliances, and they're more likely to last. And this is mirrored by the trade networks. So if you overlay this with trade has basically been the glue that's holding a lot of these alliances together. So once you have economic partnerships, you tend to have political partnerships as well. The interesting thing about this is it's also accompanied by an unprecedented decrease in the number of wars. So this is a graph from the book, which goes over the data that we had from that paper. And in particular, what you see in the red part at the end, this is a graph over time of the chance that any two countries are at war with each other. So what's the probability if I randomly pick two countries in the world that they're at war in a given period of time? And you can see that that's quite uneven over time. There are periods where you've had lots of wars, and then you have relative peace, and it bounces up and down a lot. But then you see an enormous calming post-World War II. And basically, if you by pretty much any measure you go through, this is correlates of war data, we're using 1,000 casualties to define a war, there's about a 10-fold decrease in the number of wars post World War II than there was beforehand. Now obviously, this is correlations, it's not causation. You don't have good instruments to look at alternative histories. But what is true is this lines up very well with the timing of trade. And if you do the regressions, as we did in the paper, you can see basically that trading partners have a very low probability of going to war with each other. So one real benefit of increasing trade is you increase the set of alliances, you decrease the conflict between different nations, and that sort of cements peace in. So that's one real great benefit that we've seen from globalization. And here you can see that trade has been taking off. This is trade as a percent of world GDP, and you can see basically it hit a peak just before World War I of roughly 30%. It dropped through World War II, and then it's just been steadily climbing ever since then, and now it's in the 60% range in terms of imports plus exports over total world GDP. So we've seen an enormous growth in trade, and that really mirrors the density of the overall network in terms of political alliances and peace. Okay, along with this has come an amazing drop in poverty. And the United Nations actually set what they thought was a very ambitious Millennium Development Goal to cut the 1990 poverty rate in half by 2015. And in fact, it's one of these rare cases where you set such an ambitious goal and you achieve it not only on time, but early. So it was achieved by 2010. If you look at the world poverty rate, it was in 1981 was above 40%. Now it's actually below 10%. Now, that doesn't mean that the world is really well off. There's a lot of people, this is a pretty low bar to hit, and there's still a lot of poverty in the world. But this is telling us that a lot of the globalization and trade has been accompanied by growth in the standard of living in a whole series of countries and a lot of the world population. Okay. Along with this has come some interesting changes in the divisiveness and cohesion in the world. And in the book, I spend a lot of time talking about not only that networks are getting denser, but they're also getting more fragmented. And here, just to give you one illustration of this, which I think is probably well-timed in terms of what's happening in the US Congress these days, this is a picture of the US Senate. So each point in this is a senator, and they're color-coded by parties. And what I did is, this is from code I got from Renzo Lucioni, who's a computer scientist. And I did was just scrape the roll call for all the votes in a given congressional setting. And there's a link between two senators if they voted the same way on at least half of the bills that were brought to the floor. Okay, so there's some endogeneity here, but basically it's saying more than half the time they're agreeing rather than disagreeing. And there's a link between this. And this is the Senate co-voting from the 1990 Congress. And so, and in particular, let me emphasize one thing. I didn't select where the points on this graph were on the figure. This is done by an algorithm which decides where to put nodes based on who they're connected to. So it tries to place nodes closer together if they're voting the same way, and it pushes them farther apart if they're voting differently. So it's an algorithm that figures out where the dots go. Okay, so this is 1990, this is 2015. So there's been a dramatic change in the co-voting patterns. Before there were 82% of the nodes that were linked, now there's only 53% of the nodes that are linked. And again, I didn't pull this apart. The program pulled it apart because the parties are basically not voting the same way on many bills anymore. And actually, if you look, you can see that there are some separated senators. The two on the top are actually Rubio and Cruz, and the one on the bottom is Graham. You can find Bernie Sanders here. So you can actually go through these graphs. There's actually interesting things we learned from this, but this tells us that there's visualizations we can do of different graphs, and they tell us something about the structure, and in this case, about the evolution of the political voting within the Senate. Okay, what I want you to take away from this, though, is that there are patterns within these graphs that are going to make a difference. And if we look at graphs that have splits in them, they're going to behave differently than graphs that are more cohesive. And we'll get to that a little bit more later. Okay, so now let me zero in a little bit more on financial networks and talk a little bit about the trends that have been going on in this setting. And I want to hit on two trends. The first is echoing the globalization in terms of the densification of the network, the integration that's going on. And the second is consolidation, which is that the nodes are becoming bigger and fewer. Okay, so first of all, let's just look at global financial integration. So what this does is just look at debt, equity, foreign direct investment, and other forms of lending that go into any given country on average. So if we look at typical countries, actually in total. So here in the year 2000, we had $26 trillion of investment in the world was coming from outside of domestic countries. 102 million by 2007, shortly before the financial crisis, and then by now it's reached over 130 million, out of a total of investment of about 300 trillion. So roughly a third of investment within any country is now coming from outside of that country. And in particular, if you look at foreign ownership, that lines up pretty well. If you look at the amount of equities and bonds that were owned outside of a given country, in 2000 it was about 17% for equity, 18% for bonds. Now it's up to about 27% for equity and 31% for bonds. So roughly you can think of a rule of thumb is that any given country these days has about a third of its money coming from outside of the country. This is a figure from a paper by myself and Matt Elliott and Ben Golub, where we look at the debt that's owned from within one country and held, debt that was issued from one country and held within another country. So for instance, if we look at the link between France and Germany, 18% of French debt is held in Germany. 13% of German debt is held in France. So you begin to see that there's a lot of cross-holdings, especially in Europe. This is just of the sovereign debt and often held within commercial banks in another country. And in understanding the Greek financial crisis, part of understanding that was the large exposure that European banks had to Greek debt was a big part of understanding why that was a precarious situation. And right now, if you look at, for instance, French exposure to Italian debt, you can begin to see that there's issues with potential financial instability in Italy as well. Okay, so let me talk a little bit about financial integration within the network itself, not just looking from country to country. So here, if we look at, say, just bank holding companies, so look at banks, 23% of bank assets in the US come from within the financial system, and 48% of their liabilities come from within that. So largely other people depositing, doing repos, various derivatives and so forth, and 23% of its assets. So roughly a quarter of its assets and half of the liabilities are within the financial system. So that means that banks are very exposed to other banks and other financial institutions within the system, and that those strong links are the ones that can potentially transmit shocks and are the ones that can be worrisome. In terms of consolidation, we've seen that between 1980 and the present, there's been a dramatic shrinking in the number of banks and a dramatic increase in the amount of capital that they're actually controlling. So for instance, just in the US, if we look at FDIC numbers, in 1980, there were 14,000 commercial banks controlling a little over $2 trillion. These days, it's actually about 4.7 thousand commercial banks, and they're controlling $16.5 trillion. So we've seen a threefold decrease in the number of banks and about an eightfold increase in the amount of capital that they're controlling. So there's been a lot of consolidation in the banking sector. The banks are much bigger and controlling much more money than they did before. And part of this has to do with the changes in the laws in the US, but it's something that's actually mirrored in other countries as well. So there are economies of scope and economies of scale in banking, and they're being realized on unprecedented levels in terms of the way that this network is operating. In 2016, if you looked at the 10 largest banks in the world, they control about $26 trillion. I think roughly half of those banks are in China now. The US and China GDP, $29 trillion. So the amount that just the 10 largest banks are controlling in terms of assets is roughly on par with the US and Chinese GDP. And the five largest banks in the US have gone, just between 1990 and 2015, went from controlling 10% of total assets to 45% of the assets. So basically you're seeing shrinking numbers, larger amount of capital, and more concentration among the largest of these enterprises. Now when we think about systemic risk, having a few big players can be good in some ways, but it means that having one of them fail can be quite catastrophic. So there's worrisome trends in some levels of this. Okay, so basically great benefits from globalization that we've seen, gains from trade, peace, decreasing poverty. We're seeing economies of scope and scale being realized in some of the consolidation, efficient investment. We're seeing more money move across countries, finding the places it should be. So a lot of great things happening, but we're also in an increasingly interconnected world with larger nodes and larger enterprises. And that can lead to greater transmissions and potential for contagion. So there's both sides of the coin. Okay, so that's the background just in terms of trends. And now what I want to do is talk about contagion in general, how we can think about it, and then what's special about financial networks and how things are different there. So I'll start by just previewing some ideas of what's special about financial networks. And as I mentioned before, there's externalities, and these externalities have to do with things like bankruptcy costs. So for instance, if somebody defaults and doesn't make a payment to a bank and another bank ends up being insolvent, that can incur substantial costs, and those costs aren't necessarily incurred by the people who made the original choices and investments in portfolio, but are being held by the rest of the economy. So there's external effects here that can come from liquidation, that can come from coordinating on assets. We'll talk about some of those in detail, but there's a series of different ways in which there's externalities in these markets, and that's where the first welfare theorem and basic efficiency kinds of arguments fail. And understanding where those fail and how they fail is going to be instrumental in understanding exactly what we want to measure and why we want to measure it. And I'll start by just giving you an idea of three basic kinds of contagion that are the ones that we usually think of, and we're going to zero in mostly on the third. But the ones that historically have been of interest to financial economists have been panics, runs, multiple equilibria. You see this in Keynes' general theory and talking about the beauty contest. You see it in papers like Diamond Dipvig and so forth. There's been a study of the fact that there can be self-fulfilling situations where if I think other investors are no longer going to value an asset or going to pull their money out, I want to do the same because I realize this is going to fail and I'm not going to get any money out if I'm the last person going to the bank to try and withdraw my funds. So these kinds of coordination issues are situations where there are externalities. I care about what other investors are doing. It affects the potential and the value of my portfolio. So that's one type of externality, and it's one that's been reasonably well studied and understood. And we'll see some elements of that in the structural stuff I'm going to go through as well, but that's going to be sort of a side player in what I'm going to talk about. The second is what you might think of as inference and liquidity kinds of freezes. And these are situations where there might be uncertainty about the health of a given organization, and I begin making inferences. So when Lehman Brothers goes bankrupt, I begin to wonder about other organizations that look like it, and I'm worried about their health. I also realize that they're going to liquidate a bunch of their assets. That's going to drive down the value, say, of mortgages further, and that might hurt other portfolios and other organizations, and so I become wary of that. And that causes me to no longer want to lend. I want to start hoarding money, and you get a self-fulfilling situation where liquidity dries up, everybody is hoarding cash, and you have a freeze up in a particular market. Okay, that's another form of externality where now I care about whether other people are lending to each other, who might have lent to each other. That's going to be a situation that's important to understand as well. The third type is the one that I'm going to zero in mostly, because that's the one where the networks have the most to say. And that's cascading defaults. So these are situations where one particular institution becomes insolvent and its potential default can put the balance sheet of other institutions at risk. So for instance, we saw that in the crisis with AIG, Fannie Mae, Freddie Mac, large institutions that had exposures that they weren't able to meet margin calls or payments, and their potential default could have resulted in defaults of other institutions. Now, luckily, there was government bailouts in those situations where there were payments made, and we avoided a catastrophe. But there's potential in that, and understanding that and avoiding it at minimum cost is sort of what a lot of the structural understanding is going to be about. Okay, and so understanding contagion, I'm just going to go through 3 different types of contagion. And I think it's useful to compartmentalize contagion into these different bins, because the first one is the most basic and well understood. It's the sort of disease contagion. A complex one is a little trickier, but it's something we have a good handle on in network science. And the third one is the one that makes financial networks special and something that we need to model explicitly. And the difference is, in simple contagion, think of a flu. If I bump into somebody, the virus hits me, I can catch the flu. Complex contagion is something where I need multiple stimuli. So if you put a new technology out there and you ask me whether I want to take this new technology, maybe it's a video game, maybe it's a new software package, I'm going to be more interested in taking that up if more of my friends and more people that I interact with are doing it. So it's not enough to have one other person take it up and bump into me. I might have to have multiple individuals take it up. In financial networks, that's often going to be the case as well. So if you want to put my balance sheet at risk, if you want to make me insolvent, it might mean that I need multiple failures before I'm going to fail. But the tricky part about financial contagion is it's not just the numbers, it's the actual exposure levels. So I may have different contracts with different people. Some people I have debt contracts with, some people I have swaps with, some are large, some are small, they're different size players. So in a financial network, it gets even more complicated. We're not all just one size and one type of contracts. There's variation in those things, and that makes the contagion even more complex. Okay, so let me take you through just the ABCs of epidemiology, and then we'll get into the financial contagion part. So this is just a simple network where the average degree in the network is 1/2. So what does degree mean in a network? This is the number of connections that a typical node has. So if we think of these as people, and we think of them as transmitting the flu, then this is a pretty sparse network. There's very little chance of contagion. If any particular node catches the flu, it's very unlikely that it's going to pass it on to another node. Okay, now we hit 1.5. So these are what are known as Erdős-Rényi random graphs. So these are graphs where the average degree is just randomly, all the links are randomly put around the network. And here we have, on average, 1.5 connections per node. And what you see emerging here is what's known as a giant component, a set of connected nodes that all can reach each other via paths. Okay? So the idea here is this is a more dangerous network for contagion, because if one of the nodes in this giant component got hit with the flu, then they would pass it to their friends and pass it on to their friends and so forth. It could spread to that whole component. So now you have about a half a chance that half the population would get exposed in this particular network. Okay? Okay, as we move on, once you get to 2.5, things look much more connected. Now the whole network can reach itself except for one node. And by the time you get to 5, the network begins to look like a spaghetti bowl where there's multiple paths between any two nodes and a much far greater chance for contagion. Okay, so the idea behind this is, 1 is a critical number. Below 1, the things die out. Above 1, you've got the chance for the network to become connected and for contagion to occur. And what's known as basic reproduction numbers in epidemiology are built on that. So the idea is if a particular person gets infected, how many people do I expect that person to cause to become infected in the population? Okay? So and this is going to depend on how well connected they are, how many interactions they have, how virulent the disease is, how many people are contagious, how long people are contagious. So just to give you an idea, there's a lot of variation in the world. And part of the reason people worry about measles so much is because they have very high reproduction numbers. It's very easy to transmit. So those numbers are in the 12 to 18 range. Ebola, luckily, is fairly low. It's a blood-borne disease. It's harder to transmit. It's in the 1.5 to 2.5 range so far where it's hit. And here you see, for instance, in Sierra Leone, has a higher population density than Guinea and Liberia, so it ends up having a higher reproduction number. You see more spread of Ebola in denser areas than in less dense areas. Diphtheria, mumps, polio, rubella, 4 to 7 range. So different diseases, different numbers. Okay, so that's simple contagion. And basically all you need to know is how many connections it have, and that gives you a lot of insight into what's going to happen in the network. There's also a smaller world than there used to be. So for instance, if you look at the Black Plague, it took 4 years to get from Marseille to Stockholm. If you look at Ebola, it took 1 week to get from Sierra Leone to the US. So the world is more connected. There's also more long distance travel, so disease can spread. The network, what the pattern of those links is matters as well as the overall density. Okay, complex contagion, as I mentioned, you adopt a new technology, believe a rumor, that might need reinforcement, you need multiple, that causes some additional complications. I won't spend a lot of time on that today. I'm going to concentrate it mostly from the financial perspective, where you might have to have multiple counterparties default on payments, and that's going to depend on exactly what kinds of contracts you have with them. Okay. So financial contagions, why are they special then? We have heterogeneous firms in size, roles, dealings. We have amounts of exposure differing. Another thing that's going to be very important in this setting is correlation in assets. So in a world where we're all holding the same portfolio, then we're going to tend to be more vulnerable at the same time, and defaults and payments can cascade more easily. In situations where our portfolios are well diversified, then somebody's down but somebody else is up, the defaults have less impact. So correlation in assets holdings is going to make a difference. And then the thresholds for default and cost of default are going to be endogenous in this world, and that adds a further wrinkle on the whole situation. Okay, so first main point, which is fairly obvious, network structure matters. And I think as David mentioned, it's quite evident that we've got a very interconnected world. It matters. There's a literature on this, and I'm going to pull off some particular points that I want to emphasize are going to be important for setting up some of the discussion of incentives. And that's the pattern of connections, where the shock hits, and sort of levels of exposure. And let me just start by a sort of a simple example. And what I'm going to do is I'm going to adopt an example from a paper with Matt Elliott and Ben Golub. And it's a very simple example. And just think of a bunch of banks, and they each have some exposure to each other. They each have portfolios. And what I want to do is point out the basic difference between financial networks and other networks, in that there's a non-monotonicity in contagion. And to understand that, there's sort of two different effects. As I have more counterparties, the more people I'm partnering with, the more connected the network gets. The more it looks like that 5 spaghetti bowl than it does like the 0.5. So we have a connected network. But at the same time, the more counterparties I have, the more I'm spreading around my portfolio, and the more chance that I have diversified my portfolio, and so the less exposure I have to any particular default. So at the same time here, there's 2 countervailing effects, and that means you get a non-monotonicity in the way that exposure works. Okay, so let's just go through an example, and I'll sort of illustrate some of these points fairly pedantically, but I think it's important to start. So let's think of a balance sheet here. We have a bunch of banks, and I'll make them all identical. We have, say, 100 banks. They each have assets and liabilities, and let's suppose that they all started with 10 units of investment from other banks and 10 units from deposits from outsiders. So I got some deposits, I got some capital from other banks, and I've spread this around. So on the asset side, I have 10 that I owe in terms of debt to other banks, or owed to me from other banks. And on the liability side, I have debt that I owe out to other banks. Okay? So my balance sheet in terms of banks is sort of even 10 on each side. Then I also have deposits to my outside depositors. I owe them 10. And let's suppose that my portfolio now is at 12. So I've made a couple of extra. So there's 2 in equity to the shareholders. So the shareholders have 2 units of equity. I have a portfolio worth 12, and I have these debts out. And so in particular, here I've drawn, if I had 4 different partners, an equal exposure to each partner, I have 2.5 to each partner. So I have an incoming 2.5 from each bank and an outgoing 2.5 to some other banks. Okay, so now let's think of cascading defaults in this world. So what we're going to do is we're going to shock somebody's portfolio, and we're going to see what happens in this network. So in particular, let's have some firm get a negative return on its portfolio, so its portfolio drops to below 10. So it's no longer solvent in terms of the liabilities that it has. So it can't pay its debts, and then we see what happens to this. Okay. So for instance, a bank's portfolio drops to 8. So now it still has these, it's wiped out its equity, and now it still owes 20 out, but it only has 18, so it's insolvent. And I'm not going to worry about the bankruptcy costs and so forth. Let's just, for the moment, for this example, just suppose that the bank freezes up, nothing's paid, and now these other banks are going to be hit by this. So the 2.5 doesn't go out to the other bank. Okay, so now we think about what happens on the other side. So the next bank, it becomes insolvent. Why does it become insolvent? Well, it's still got its portfolio at 12, but it didn't get the 2.5, and that's written down now. So now it's only got 7.5 worth of debt, and it's only worth 19.5. So it can't make its payments out. It freezes up, and so now we've got a situation where these 2.5s stop going out, right? So it can't make a 2.5 payment, and now we begin to get a cascade. Okay? So that's the basic idea of how this is going to work. And what I want to do is just emphasize the point that it made a difference, sort of what these numbers were and how many arrows were going in and out. So if instead I had 10 arrows going in and out, right, instead of 4, then each one of these would have been 1 instead of a 2.5. And so if I had enough different partners, now if one of them defaults on me, if that first one has a bad portfolio and doesn't pay me, I still am solvent. Now I'm down to 21 instead of below 20, and so I can still make my payments. So the idea here is, as we're diversifying this set, the exposure to any particular counterparty is less, and that causes less of a potential for contagion. Okay, so it's a very simple point, but it's really basic to the whole understanding of why these networks are going to be a little more difficult to deal with, because we've got these non-monotonicities in terms of the amounts of exposure is changing with the number of counterparties that I'm dealing with. So here's just a simple diagram of what happens then if we look at the average number of partners, and we look at, say, the amount of defaults we get in that example. So let's suppose we shock one, we look at a network where I'm just varying the number of connections in that network, so on average from, say, 0.3, 1.7, 3, and so forth. So I'm changing the density of this network and then looking at what happens in terms of the overall size of the cascade. And the worst situation is sort of that 3 point. The 3 point is really bad in this world. I have 3 partners. That's enough to make the network fully connected, but now I still have substantial exposure to each bank. Once you get above that, then it starts to come down. So once you go beyond that, now I have less and less exposure. The network's getting denser, but the fact that I'm less likely to be hit by any particular counterparty then alleviates things. Okay, so low connectivity, network doesn't connect, you're safe. High connectivity, you do well because you're well diversified. There's sort of this sweet spot where things are dangerous, where there's a limited number of connections, but enough to connect the network. Okay, so just to emphasize the point, this is a relatively safe network, not a very interesting one because there's not much going on in terms of investment. The risky situation is when you end up connected, but with large exposures to each other. You're safer actually having a more connected network with smaller connections to each other. And this is where the pattern of consolidation is going to begin to play in. And so again, I'm going to do this sort of conceptually in terms of pictures, and then I'll take you through it in a little more detail later. So the level of exposure matters, and the more exposure we have can lead to more efficient investment, but it also can lead to more possibilities of contagion. So for instance, if we redid that same simulation we had before, where instead of half the portfolio of each bank going to other banks, I made it 40% or 30% or 20%, we'd get a different picture each time. So sort of how interconnected and how dependent banks are on each other's balance sheets is affecting this as well. And as we decrease that exposure, we're decreasing the chances of contagion. Okay. Consolidation has an impact too, and core periphery kinds of structures have a big impact. This is something that's been looked at more recently in a series of papers of people modeling core periphery networks. But here we end up with different types of exposure. And in particular, if we went back to that picture before, and instead I drew it so that some of these networks, some of these institutions were much larger than other ones, and they had much more substantial exposure to each other, then it begins to look more dangerous because the failure of one of those large institutions could bring down other large ones and potentially cause failures in the network, even though we're in a situation where we're beyond this sort of normal point where if everybody was even sized, things would have been okay. And why is this troublesome? Here's a picture of the actual FedWire interbank payments. This is from Kimmo Soramaki, from a paper in 2007. What this is looking at is interbank loans. And so the width of the link between different nodes is representing how much capital is flowing between those nodes. And you see a core of about 25 banks. This is the core periphery structure where they're completely connected and lending to each other. And five very large ones, JP Morgan Chase, B of A, Citigroup, Wells Fargo, and Goldman are basically the 5 largest in this particular picture. And they're lending heavily to each other. And then regional banks tend to be connected to 1 or 2 of the core banks. But here, once you get to this structure, now you begin to worry about this sort of too connected or too big to fail scenarios occurring. If one of these large banks gets in trouble, it's a much more susceptible world than one where we had this all evenly spread out. Okay, so consolidation in this core periphery structure matters as well. Okay, now what I want to do is take you through, so I've just given you some basic ideas of how contagion works, the fact that there are these trade-offs, and that it matters who's connected to whom and what their portfolios look like. Now I want to take you through and just set up a really basic model, simple model, and then look at the incentives that people have for investments and how this plays out in a financial setting. Okay, so 3 things we're going to look at in terms of the externalities. One is the choice of portfolios that banks make. The second is who they partner with. And the third is the correlation structure they choose in their portfolios. So do I choose to have an independent portfolio from my partners, or do I choose to have a correlated portfolio? And just to say that, there's a literature that looks at these kinds of questions. So the paper that's posted will give you a lot of references. I've put some on the slides here of papers that have looked at some of these questions. I'm going to do it here in a very particular model that will allow us to do a series of these different questions all at once. And what we're going to do is I'm going to take a model which is a generalization of a model by Eisenberg and Noe and Guy and Kapadia and the paper with Matt and Ben. And what we're doing here is we're going to be mixing debt and equity. So we're going to allow people to have different types of contracts, debt contracts or equity contracts, which you could think of in some cases as swaps or other kinds of contracts. So they're going to have two different types of contracts, and they're going to be partnering with multiple other institutions, and we're going to look at their incentives to make investments and to partner. So let's think of N financial institutions. So these are the ones where we're going to be interested in. These could be banks, broker-dealers, et cetera. And I'll have a bunch, sort of a residual outside investor that we'll think of as sort of bringing capital in. These are people who either are the depositors into the banks or the businesses taking loans out from the banks. But these are people who aren't dealing on both sides and sort of have potentials for transmitting shocks through. So think of those as the outsiders. They're sort of the sinks in this network. And then each node is going to have a value of its investments, this portfolio of investments. And the particular values that we'll be looking at will be the value that of a given organization I is its value of its direct holdings. It's got a portfolio. Then it's got debt in. So I look at all the other organizations J, and I've got the debt that's owed to I from J. So somebody else has issued a bond that I bought. They owe me some money. Or I've made them a loan. So this is debt that is supposed to be coming into me. Then there's minus, the opposites switch in notation, DJI. This is the amount that I owes to J. So I've got a bunch of debts that I owe to other people. And then I also could have some equity-like holdings. So these could be anything which is going to depend on the level of the value of other organizations, not just a fixed set payment. So I've got some cross holdings. It could be shares that I've bought in some funds. It could be swaps of various forms, but we'll treat these like equity. Okay, so that's the value of a particular organization. So I'm just going to sort of, for the moment, just think of the total assets into an organization, DI assets, liabilities out, and then these cross holdings and the value of my portfolio. Okay. So when you look at that, now you've got a simple system of equations and unknowns. You can solve for the values in this world. So the value is just I minus S inverse times this portfolio values and the differences in debt. So it's a simple set of equations and unknowns. It's very easy to solve, and we get a solution to this set of equations. In the paper, I'll talk. You need some conditions to make sure that the matrix has non-zero rank, and you can invert it. But these are small technical conditions. So this is more or less a Leontief calculation of value, going back more than a century in terms of the way that people have looked at these things. So very simple calculation of value based on these portfolios. Okay. So now, what's the key thing? We've got that if the value of some organization drops below 0. It becomes insolvent. So if the value of my portfolio plus the assets I'm holding in terms of debt plus the share is less than the debt that I owe out, I'm insolvent. Okay. So what we're going to, in particular, impose is where the friction comes into this market. Without this, there wouldn't be any frictions. It would just be that the drop in my value would cause drops in other values. But here we're going to get a discontinuity. And the discontinuity comes from the fact that if I freeze up, there's going to be an actual loss in value. And the cost of bankruptcy, I want to emphasize, can be substantial. So that's really key to understanding the real inefficiencies in these markets. So fire sales, early termination of contracts, negotiations in these settings, delays, legal costs, contracts that are not upheld by the courts, these can be large. So just empirical numbers, typical bankruptcy recovery rates, of all businesses are in the 56 to 57%. Financial firms, it's roughly the same. Of the 44% that's lost, about 4/11 of that, a little less than 40%, is in terms of legal costs, and the rest of that is from liquidation of assets. So the assets are often sold at values that are below what they could be. Recovery rates on these things drop by about 15 to 22% if you're in a period of financial contagion or distress. So the worse the markets are, the worse you're going to get in terms of finding buyers for these things. And just to give you one example, if you look at Lehman Brothers, in Lehman Brothers, when they opened for bankruptcy, there were $1.2 trillion of claims made against Lehman. Of that, the courts actually allowed $362 billion they thought were valid claims. And out of that $362 billion, 28% were eventually paid. So you start with a pretty high number, you take it down by about a fourth, and then you get about 28% of that was the amount that was actually paid out. So in that case, very little of what they owed was eventually paid out. So these costs are not minuscule, small costs. They can be quite large, and that is what then causes problems in the system. Okay, so one thing that also does to the financial system is make for a very particular, interesting equilibrium problem in terms of the basic economics of it. You end up with multiple equilibria. And just to emphasize this point, let's look at whether or not I'm insolvent. So we look at, I've got these value of assets on the left-hand side, and what I owe on the right-hand side. If my assets are lower than my liabilities, I'm insolvent. There can be multiple equilibria in this setting. If I think that the assets coming in are going to be low, then I'm going to incur this bankruptcy cost. That's going to put me below my liabilities. I'm insolvent. If I'm insolvent, then I'm not paying to other people. That depresses their values. So if I have low values, they have low values, and we get an equilibrium where we all default and everybody's owing each other money and can't pay. On the other hand, there's a higher equilibrium where if I believe everybody else is solvent, then I have enough to pay on the left-hand side, and I don't incur the bankruptcy costs. That keeps my value high. I make my payments. Everybody else's values are high. So this is actually a setting where you've got a nice monotonicity. You end up with a complete lattice of equilibria. So you end up with multiple equilibria, but they can be well ordered. There's sort of a best equilibrium where we keep everybody solvent, and a worst equilibrium where a bunch of people become insolvent, and that drags everybody else down. Okay? Now, one thing I want to emphasize is this is not a theoretical artifact, because when we have freezes and so forth that we talked about before, if people suddenly don't believe that other people are going to pay and start hoarding cash, then that can become self-fulfilling in terms of you're sort of moving in some sense from one equilibrium to another. And the system itself, this is somewhat endogenous, and it's possible to have the multiple equilibria really play out in practice. And so in what follows, I'm actually going to pay attention to both the best and worst equilibrium, because I think they're both relevant in reality. Okay, so now let's just look at some simple incentives in this kind of financial world. So one point I'm going to make is that too much risk is taken. The second point I'm going to make is that institutions are going to tend to partner with too few partners. And third is they're going to have an incentive to correlate their investments with those of their partners. And so let's start with the first one. And the first one is actually something that goes back to the original Jensen-Meckling kind of idea of other people's money. So the idea here is, you've got some institution, it's choosing investments, and its investments, say I'm choosing, think of your simple CAPM kind of model. I'm choosing somewhere on the frontier how much of the risky market portfolio I want, how much of the risk-free asset do I want, and I'm going to make a choice which doesn't take into account the counterparties that I owe money to payoffs. And in particular, let's think of the following problem. So I've just written down a particular bank's value, and it's QI, some fraction of its money it's putting into the risky portfolio, PI, and 1 minus QI it's putting into a risk-free asset that just pays a known interest rate R. And then it's got the rest of its balance sheet, this debt that's coming in, the debt going out, and the shares it's holding. So I'm just doing this one risky choice. And when we do this, what it's maximizing, if they're the shareholders, what they care about is, they care about maximizing the expected value conditional on it being positive. If it becomes negative, it goes into bankruptcy, limited liability, they walk away, they get 0. So the rest of the expression is 0 here. And they're caring about the positive part, okay? And one thing I'm doing it all in terms of risk neutrality, just to make sure that we're going to get the structural parts that matter rather than risk differences as driving things. So everybody's risk neutral, no risk aversion here. Okay, so that's what I is maximizing. Let's think about what society's value is. Well, society's value, in terms of considering the full network and all the other banks and investors, they care also about what happens once the value drops below zero. So if this bank becomes insolvent, it's going to incur this bankruptcy cost. That's going to be a real cost to the society. And it can also incur any contagion cost. So it could be bringing down further institutions. So when we think about these, the key thing here is these are negative values. It's all negative, and it is more negative the higher the risk that's taken. So the more that was invested in a risky portfolio, the less you have left in situations where it doesn't pay off. So in situations where you end up liquidating, that is just lost cash. And so basically, all of this is negative, and what that tells you is that the bank has the wrong incentives in terms of this investment. So it's just a very simple point, but it's an important one. So it gets the upside value, it doesn't suffer the downside losses that are being incurred to the society, and so it overinvests in the risky portfolio, okay? And so that's just a basic point, but an important one in terms of what the risks that are going to be taken. And this means, you're going to see excessive leverage and so forth in the financial system, something we know quite well. Okay. One point that's interesting here is that debt versus equity actually makes a difference in this calculation. So this is a world where Modigliani-Miller fails. The debt and equity mixture that you have actually makes a difference in whether or not there's an externality here. If we were in a world where all of the financing from other banks was completely on equity side, then there wouldn't have been a debt liability and an insolvency point, and there wouldn't have been this externality. So the value there wouldn't go negative, and you wouldn't have that actual cost incurred. So the incentives would be better aligned in this world if we did all of our financing by equity rather than debt. Now that's not to say that that's the right answer, because there's a lot of other reasons for having debt rather than equity that we're not putting into this picture. For instance, if the debt is to my depositors, they don't want to just be holding equity you don't want to put cash into the bank and then just get a random payment back from the bank. A lot of people want to have their paychecks go in and actually know how much they're going to be able to have to pay their bills at the end of the month. So there's reasons to have debt contracts, but that they have different incentives, and that's one thing that comes out of this kind of very simple model. Okay. That's one point. Second point, too few partners. And the too few partners, let's think of a simple world where I have a cost to forming a partnership. So for whatever reason, if I want to strike up a deal with another enterprise, I've got to contract with them. I've got to sign papers. I've got to get to know them. There's costs involved. And let's think of this world where I'm either, we're swapping debt or equity, whatever, but I'm going to think of a very simple situation where effectively, if I have more, the more counterparties that I have, basically what I'm doing is just splitting portfolios. So let's think of these banks as more or less equally investing in these things to make things simple and symmetric. You can do it in an asymmetric way, but this will make it very transparent. So what I'm doing is I'm either splitting my investment with M partners or M-1 total partners in this consortium of banks doing these investments, okay? And so basically, if we do more investments, we've got a more diversified portfolio. And so the idea here is, from a given bank's perspective, what am I looking at? I look at what's my expected value conditional on having M partners compared to if I just partnered with M-1, and I'm willing to add that extra partner or to spread my portfolio around more, as long as that is exceeding the cost of dealing with one more partner. And you could think of this as generally having diminishing returns, both from a diversification perspective and from how things are going to play out in terms of the overall values that are being split up. So as I increase this, eventually I'm going to find some point where I don't want to add more partners. Okay, what's the societal consideration? The societal consideration has this extra part, which is I don't just care about the value when it pays off to be positive, I also care about the incurred bankruptcy and contagion costs. Just as before, these extra costs are ones that are going to be borne by the society, and that also has to be weighed against the chance of default that is changing from M to M-1. And so here there's an extra effect, and again, this extra effect pushes you in a direction that now society would like me to add an extra partner when I don't want to. So my individual incentive is to keep fewer partners. I'm not worried about the diversification as much in terms of its effect on the outside. So this is a similar kind of incentive problem as the previous one. It's just now on the extensive margin instead of the intensive margin. Before I'm just taking more risk in terms of my portfolio. Now I'm taking more risk in terms of partnering with fewer partners. Okay, so that point should be clear as well. Okay, now the last of the incentive points I want to make has to deal with correlated investments. And this is, I don't know how many of you know the sort of metaphor for popcorn or dominoes that Eddie Lazier came up with after the 2009 conference. So Eddie Lazier is a friend and colleague at Stanford. He was the Treasury Secretary under Bush and during the financial crisis. And one point he made was, well, is this popcorn or dominoes? And what does the metaphor mean? Well, popcorn was saying, look, there's a lot of financial institutions in distress, but mainly because they're all boiling in the same oil. And the same oil was a distressed mortgage and subprime mortgage market. So they all have a lot of exposure to the same investments, and so they're all going south at the same time. And it sounds like they're contagion, but that's just because they're popping at the same time because the oil boiled at the same time. They all got exploded at the same time. The dominoes is instead, there's actually default risk, and one can lead to another. And the point I want to make here is that, first of all, during the, if you read the congressional report that was written after a bipartisan congressional report that was written after the crisis, it makes it very clear that if they had let AIG fail and they had let Fannie Mae and Freddie Mac, that there would have been dominoes. So it would have been cascading defaults, not just hot oil. But also the fact that if you are boiling in the same oil, the domino danger becomes higher at that time. So the fact that we're all already suffering in terms of our balance sheets means that we have fairly narrow margins, and the fact that then we have correlated portfolio means that we're more likely to be susceptible to defaults by somebody else at the same time that they're likely to default. And there's a second part to this, which is that fire sales of assets also cause problems in the same time period. So if I have correlated assets with somebody else, they start selling those off. That depreciates the value of my portfolio, which then can push me into default. So these things all move in the same direction. Okay, so just to understand, why would banks have an incentive to correlate their investments? And again, this one's probably the most subtle of the three. The others are fairly obvious. But this one's very important. And this actually is a point that's also made in a paper by Elliott, Georg, and Hazel in a new paper. This is going to be slightly different than their point, but I think it's an important point that banks have incentives to correlate their investments. So let's think of two banks. They each have debt to the outside world. So they've got some debt to the outside world, and they can choose an investment that pays off either R or 0. So I've got this binary, to make it simple, it either pays off R or it pays off 0. And we can share these equally, okay? And I can choose one that's uncorrelated with my partner, or I can choose one that's perfectly correlated with my partner. So what's my incentive? So I either, we both have these two investments, and I can pick one that pays off the same time or pays off in an independent way. And what's my difference? So let's suppose we're partnering evenly on these things. So if I take the undiversified correlated investment, it's basically as if I'm just investing on my own. There's a theta chance that this pays off. If it pays off, I get R minus my payment to the debtors. So I get R minus D. That's my payoff. Okay, theta chance, I get it. Now let's think of, instead, we do the right thing in terms of diversifying our portfolios. We share equally in independent draws on this thing. There's a theta squared chance now that they both pay off. We get R minus D in that case. There's also a chance that one of us gets a payment and the other one doesn't. What's the chance of that happening? Theta on one minus theta on the other. There's two different ways it could happen. And let's suppose we've equally partnered here, so we share the R over 2. Then what's my payment? R over 2 minus D out. Okay. So the second payment is what I get by partnering and doing a diversified portfolio instead of the undiversified portfolio. So I'm still getting the R, but I'm solvent more often. Okay, so when we look at this calculation, what happens? Well, if you simplify the second one, it looks like the same amount as the first one minus an extra term. So it's just unambiguously, it gives me an unambiguously lower payoff to take the diversified portfolio compared to the undiversified portfolio, okay? And that's sort of counterintuitive to diversification, but why is it happening here? It's happening here because I'm getting the same return across different states either way. I'm getting the R either way, but what I'm doing is what we call, it's a form of risk shifting, we call it risk stacking. I'm basically stacking all my payoffs in the same period where I'm already paying the debt. I might as well have more return in the periods where I'm already paying debt than to add more periods where I'm going to pay debt, or more states of the world where I'm going to pay debt. Right? So this is a form of risk shifting where basically the total asset on the return is the same, but instead, if I do the uncorrelated part, I end up paying the debt out more frequently, and so I'm going to end up I'd rather be insolvent when the other bank is insolvent than sort of increase the times that we're solvent for the same return. Okay. You can do the same thing with risk aversion, but the basic point is that the incentives are misaligned in terms of correlation. We'd like to correlate our portfolios. So one question you could ask is this sort of a real effect? Let me say one thing. Yeah, I mean, so this has impacts for the non-monotone contagion. If we're correlated, the contagion gets worse because now we're depressed at the same time. I'm going to skip that, but let me just take you through a little bit of data on this fact. So in the paper, the Elliott, Georg, and Hazel paper, what they do is they look at German banks, and they're finding that they're more likely to lend to each other the more similar their portfolios are, and they're more likely to partner with those who have the most similar portfolios. Now, this isn't causal in the sense that this is the reason that they're making these kinds of investments, but what it is saying is that there is a correlation between the investments in the portfolios of people who are most closely partnered. And in particular, what they find is that in their data, the interbank lending and equity is about 17% in terms of how much exposure they have to each other. And if you change a bank from two banks from the 25th percentile to the 75th percentile in terms of how similar their portfolios are, you increase their lending by about 31%. And what they're doing in their portfolios is just looking, they have a sort of a Euclidean distance on different sectors that they're lending to. And the more similar their investments are in terms of sectors, the more likely they are to be partnering with each other, and the more likely they are to be lending more to each other. So you see correlation in these investments, and that actually plays a role. Okay, the last thing I want to sort of touch on is addressing the systemic risk. And in the book, I have a section which I call Flying Jets Without Instruments. And the analogy here is when you actually look at, let's suppose we look at a network and we've got a picture of all these financial institutions, and we want to do some systemic stress testing. So we want to figure out what the risks are, who's at risk. We want to figure out where we might want to intervene or who's in distress. In order to do that, you actually need to see the full network. So just getting balance sheets in terms of overall debt in and debt out without knowing where the connections are and how many connections and who the counterparties are and where those counterparties are, we have really no way to get an accurate estimate of exactly what the systemic risk is. Now, there are some countries, mainly in Europe, where central banks have more detailed balance sheet information about counterparties and counterparties of counterparties, in particular of some debts between banks. But it's very rare for a country or a regulator to have a very particular picture, a very crisp picture of what's going on. And you can think of these as, as complex as flying a jet, and you wouldn't want to be flying a jet without, any gauges to tell you what your speed was or what your altitude was or what your direction was. So, here you need the full network, not just the balance sheets, and that's sort of important. Let me make a couple of quick points about what you do with the balance sheet information and then how you measure this. So one point that goes back to our early picture of sort of, if you want to step in a particular setting and eliminate risk, let's suppose we go back to just understanding, say, vaccination. How does vaccination work? Okay, here's something where we've got a society that can be exposed to a contagion, say a flu. Basic reproduction number is 1.5. And now I want to vaccinate the population. Normally when you think about vaccinating the population, you say, well, you need to vaccinate everybody and you make them all safe. Well, let's suppose we just vaccinate a third of the nodes in this picture. So we just randomly pick a third of the nodes. We could do even better if we're very judicious in which third we picked. But I'll just randomly scatter a third of the nodes to be vaccinated. If we do that and cut basically now they can't be infected and they can't infect anyone, now the network that results, we start with that, we end up with a network which is now very disconnected. So, the amount of safety that you need in a given system doesn't have to be that everybody's bulletproof. It just needs to be that you have certain kinds of firewalls and certain institutions that you've taken care of, and that's enough to make sure that you're not going to have a widespread contagion. And the same thing will apply in any of these network settings. You can do this in a financial setting where you have particular institutions that you're sure are solvent. What you worry about is having strings of insolvent institutions or close to insolvent institutions close to each other. Okay, so now in this kind of model, you can do this kind of calculation quite straightforwardly. You can look at the actual N, the contracts that they have with each other, D and S. In the paper, we go through more complicated contracts, but you can think of just tracking who's connected to whom, what the portfolio values are, and then it's fairly easy to figure out what somebody's potential cost is to the rest of the society. Now, this is easy conceptually, very difficult in terms of data. So what you need is basically to be able to calculate what are the values of all the different portfolios and holdings if I make all my payments, and what's the cost of me dropping my portfolio and defaulting on some payments. And you need to be able to trace that through in a string throughout the economy. So you need all the balance sheets of all the players involved in order to do this. But if you have that information, conceptually the idea is it's just immediate. You basically just look at the equilibrium where somebody has a higher portfolio, you look at it with a lower portfolio, and you can figure out what their impact is by a change in the portfolio. And I think one kind of thing that in the paper you can do different approximations. We talk about how you can approximate this. The key thing, it turns out, if you want to look at the network, is you need to have at least one solvent institution on every cycle. So if you look at every cycle in a network, if you've got one solvent institution, that's enough to break that cycle apart. And so having one solvent institution on every cycle is enough, if you wanted the minimum amount of payments you can do in order to firewall a network, that's the minimum cost way to do it. So we talk about the minimum way to inject capital in order to do this, and basically it's a very simple calculation. Now, simple conceptually, it's an NP-complete problem for people who know complexity analysis. It's actually a hard problem computationally, but it's not a hard one to think about. And there are algorithms that can do this. Okay, now in terms of regulation, what are some of the lessons from some of this? First of all, you need to understand the network itself, not just the balance sheets. So to assess systemic risk, having detailed information of counterparties and counterparties to counterparties is essential. You can't really do systemic risk without that. And one thing to say just about systemic risk calculations, they're very different on a one-by-one basis than they are on a system-wide basis. So if we're looking at 100 banks, a 1 in 100 event for one bank becomes an almost sure thing to happen somewhere in the economy. So the levels of what's an extreme event are going to be different when you're doing a systemic stress test than when you're doing a one-by-one stress test. And so here when you want to do this kind of analysis and vary these values and then see what the potential financial centrality of one of these institutions is, you want to be operating at a different significance level than you would if you were doing a one-by-one institution analysis. Okay, kinds of concerns that came up here: excessive risk and leverage. too few partners, incentives to choose correlated portfolios, excessive consolidation. I didn't talk about that. We have some discussion of that in the paper. So when is it that banks want to merge? Actually, Zafar Kanak, his dissertation was on mergers of banks to try and change the cascading in banks. By merging institutions, you change the balance sheets. You can make them solvent when they weren't solvent before. That can make a difference in how things play out. So there are also incentives that are misaligned in that world. Obviously, this opens a whole can of worms in terms of bankruptcy rules. If you can have bankruptcy rules that are a little easier in terms of stopping payments and figuring out how to unwind contracts, that's one way to think. People have proposed CCPs, basically having a network that begins to look like a star, where you have one institution that's dealing with a lot of the counterparties and everything flowing through one institution. That can be great in terms of, now you just have to watch that one institution, but if that one institution fails, then you're in real trouble. So there's trade-offs in sort of network structure that you can think about as well. Just a final thought in terms of this, I think of this as like earthquake preparedness. These are rare events, but they do occur, and when they do occur, they can be catastrophic. And I think the good news about financial systems is that we have much more of an understanding about when we're in danger, and we can measure these things. We do understand how they work. We have the right tools to do it. We just need to get the information to be able to do it. Whereas in earthquakes, I think we're far from being able to predict when the next earthquake might hit. So here, given the right information, this would be feasible. We're not at the state where we actually have that information in the right hands yet, but it's something that's at least conceivable. So thank you very much. For more details for some of the background on this, both the paper with Agata that we posted just today, very preliminary, so excuse it. We'll keep updating that over time. And then the book that'll be coming out in March. But thank you very much for your time.
Thank you very much, Matt. So I want to thank you for a really fundamental, deep lecture that's very important. And so we have time for a little bit of Q&A. And if you have any questions, please come to the microphone. And while people are stepping up to the microphone, I have a question, which is, there's a pathway of causality that I'm wondering whether your model is compatible with. So if we think about the rise of mortgage securitization and how, in a way, this is like a great increase in connectedness, because perhaps through an intermediary, I can lend cheaply to thousands of mortgage borrowers. And in particular, a benefit of this is the kind of diversification benefit that you've talked about. So you can diversify away idiosyncratic risk. But then that creates an incentive response that because I can lend with very little idiosyncratic risk, I am willing to lend more, or people are willing to lend more. And in particular, they're bearing systematic risk, the systematic risk that doesn't go away at all. And so where at first glance you have this force that says greater diversification, that's the force that is going against systemic risk, there's a sense in which it can potentially contribute to systemic risk. Right.
Yeah, no, I think that's part of this sort of basic trade-off that I mentioned at the beginning in terms of globalization. There are great benefits to sort of having more opportunities to lend and to making an increasingly interconnected world where we are packaging these things and we're doing it in a more efficient way. So that's the great news, but that also then opens us up to these shocks. And I think in particular, one thing that I spend more time in the chapter than I did here, obviously with the subprime mortgage and mortgage more general crisis, there was a real problem in rating agencies and other kinds of incentives that went along with this. And part of it is not only knowing what the network looks like, but really knowing what the value of the assets is as well, which is another tricky part. And but you're right. Somehow the more we're interconnecting the system, the more the shocks transmit. And there's benefits and costs to that, and we just have to realize the costs and contain them without ruining the benefits that go along with it.
Right, right. So I agree, but what I was angling toward is that this higher connectedness and diversifying away idiosyncratic risk itself, that very virtue of it, creates the incentive to increase the magnitude of it, the intensity of the
exactly. Right. And I think that that's part of what you're seeing in the sort of overall growth in trade is coming from the fact that these larger consolidated institutions can better package trades from around the world, and there's real economies of scope in that, in terms of that diversification. And now that's part of this huge growth you're seeing in capital invested around the world is coming from that. So that's the real good part of the story.
Yes.
Yeah.
Very good. So why don't we take the first question from the microphone?
Could you comment on managing risk in a national system such as the U.S. when the shock comes from outside, such as another nation, which is much, much less within the scope of regulation?
Yeah. I think that's one of the biggest challenges in this. I don't have a good answer to that. I think the real difficulty is that, suppose if the U.S. decided we want to make everything completely transparent, we want all banks to report all their counterparties and everything, we could get just a snapshot of the network that we'd have all these edges pointing outwards, but we wouldn't be able to see the network beyond the borders. And so you might have, you have general pictures of these things, but I think the way to address that is, there's ways of just doing simulation kinds of analyses where you're going to have to take different scenarios and figure out what might be going on beyond the borders. And hopefully, eventually, trade agreements will not only involve tariffs and so forth, but also involve information sharing between different regulatory agencies to understand what's happening in different financial systems. Now, this is purely from a mechanical perspective. So there's all kinds of privacy issues, and companies worry about giving out information about their portfolios, and that makes all of these issues a really big challenge. But I think even in the U.S., if you get a complete picture internally, you still have a lot of difficulty in figuring out what's going on. And at best, then you can do sort of worst-case scenario evaluations, and those might be a start, but otherwise you need somehow to partner with other people to get more information. Yeah, great question.
So I was wondering about structured deals. So structured deals look a lot like corporations, and you have dependency from the top down to the bottom as the money comes through, but you don't have bankruptcy costs. How do they fit into this?
Yeah, no, so I guess the simple point we were trying to make with just debt versus equity is already saying that the method of contracting can make a difference. And there are ways to structure contracts that are going to be safer than other ways. And I think the more that people understand, I think those come in particularly because people have begun to understand more about counterparty risk. And you can structure these contracts in ways that are less dangerous for the parties involved. I think the hard part is that doesn't necessarily take into account all the other counterparties that aren't necessarily part of the structured deal. And so it's really difficult to have all the contracting, to make sure that my counterparties aren't doing other contracts that I'm not part of. And that's where the incompleteness sort of fails. And so it's not sort of a fix-all to the system unless you have a really holistic contracting world. Yes.
Matt, I have a modeling issue with respect to the cross-ownership that you had in your model. I think our banks don't own that much of each other in terms of cross-ownership. It also violates your assumption about the security market line. But I think when they do have swaps, I think those are more debt-like instruments than they are equity. I don't know if that makes a difference, but I wanted to ask you.
Right. And actually, the part of the reason we put in debt versus equity in those, you're right, that a lot of the when we look at the balance sheets, most of it is debt-like looking. Some derivatives and then debt. And the idea of bringing the securities into this have to do more with also looking at financial institutions that maybe look more like hedge funds and other kinds of things where there's more equity looking like partnerships going on. And secondly, also that it makes a difference. And so if we want to understand the difference that, say, certain kinds of funds have for investing versus banks, we might understand that banks having more on the debt side and other kinds of funds having more on the equity side can give us a lens to look at the differences between those kinds of investments. But you're right, from the banking world, a lot of it looks like debt, definitely.
Are there any further questions? Okay, well, with that, I want to thank you again, Matt, for a very fascinating
Thank you very
lecture.
much for your attention. Thanks, David.